Greetings all, Reggie Middleton back on a quarantine Tuesday. Now, as for our multidisciplinary bent, we also are very strong in fundamental analysis and global macro analysis and valuation. With that being said, if you look at any of my previous videos, I've been warning since, I think, January or February that we're going to a big crash. That big crash is actually going to be a depression. Those who feel that the economy, the country is just going to bounce right back after the virus subsides, with all due respect, I don't mean to be offensive, but you're out of your minds. And I say that respectfully. I'm not trying to ridicule anybody. We entered into this pandemic with a multi-asset bubble that was popping. If you take a look at the unemployment numbers, which look very, very bad, they look very, very bad, but they haven't included the COVID lockdown. The unemployment numbers that came out with the 270-something thousand job contraction, which is the first contraction in employment and jobs in the United States in the last 10 years, and that count ended March 12th. Okay, and the lockdown occurred after March 12th. So those horrible numbers that scared everybody didn't include the horrible pandemic and economic lockdown that's frightening everybody. Okay, the following week, that week we had, I think, 3.6 million or so unemployment claims, insurance claims. The following week, they were expecting a little more. It was much more. We have a total of roughly about 10 million for that 2-week period. Okay, so in that sense, we're out to short companies that are, how do I put it, leveraged into the economy. Okay, retail is obvious, and we got off to a late start. Okay, but we also have banking, finance, the fire sector, finance, insurance, and real estate. Okay, let's focus on the consumer companies, because consumer credit and finance companies are, not only do they do business with people and are sensitive to unemployment, they're leveraged into unemployment. Okay, some companies are better off than others, but in general, that is the wrong business to be in. Okay, but there's also a lag. Retail shows almost instantaneously the effects of high unemployment, people not shopping, etc. The consumer finance companies have a lag. That lag is also exacerbated, or the effects are exacerbated by the fact that their entire business is leveraged. The way the business model works in banking, you get, let's say, $1 billion in equity, then you borrow another $20 billion with debt, IOUs, bank deposits, and then you loan out $21 billion. Okay, you can only afford a 5% move in that $21 billion portfolio before all your equity is wiped out. That brings us to our first short, Synchrony Financial, which is GE Capital's lending arm that was renamed credit card arm. We put this out as a freebie because it's been 10, 12, 13 years since we were publicly shorting companies, or since we started publicly shorting companies. We started in 2007 with General Growth Properties, with Bear Stearns, with Layman Brothers, with Countrywide, with Washington Mutual, etc. Extremely accurate, extremely detailed, and most importantly, we were right. Roughly 5-6 dozen calls. Okay, with Synchrony, let's start with Synchrony. Okay, the big thing about Synchrony Financial is that they have a large amount of level 3 assets. Okay, and it's even larger if you take it as a proportion to their actual equity. The 3 months, the quarter ending December 30th, 2019, they had 608% of their equity in level 3 assets. Okay, level 3 assets are assets that are difficult to price. There are 3 levels in GAAP accounting. Level 1 assets, which have readily attainable prices. Those would be exchange traded assets such as stocks, exchange traded stocks, exchange traded bonds, etc. Level 2 assets would be assets that don't have readily available publicly traded price, but it can ascertain a price or a value based upon those quotes. So secondary would be derivatives, okay, that have inputs from these level one assets. Okay, so the pricing is not as tight and not as accurate, okay, but it is attainable, it's easy to back into. Level three assets are assets where it's management's opinion, it's just a guess. Level three assets are by definition and by nature very illiquid because it's very difficult to know what they're worth. Much of the value comes from holding them to maturity. Okay, now of course, holding them to maturity gives you a lot of potential volatility and very large spreads, because what you consider to be worth par at 100%, 100 cents on a dollar, someone else may consider 80 cents, and the next person could be 110 cents. One very simple and obvious example of a level three asset would be a credit card debt portfolio, especially a derivative portfolio, such as an asset-backed security with a bunch of credit card loans in there bundled in. Okay, so keep that in mind. With 608% of their equity in level three assets, and take a look at this. And non-performing assets, basically credit card loans that weren't paying and were performing. The 3 months ending 2018, 14.45% of their equity were loans that just weren't being paid. 20% of the equity, 3 months ending March 2019, 20% of equity, non-performing loans. That's a lot. A fifth of their equity is dead. Okay, 18.28%, 17.84%, and 12.43%. Yes, it's went down, right, with December ending 2019. 3 months later, the entire world is shut down. Okay, businesses are shut down. People are ordered to stay at home, and we had the largest unemployment claims rate in the history of this country. Let's look at this visually. So here we have a chart showing continuous claims, uninsured, insured unemployment claims from 1967, that was the year I was born, do the math, right, to 2018, March, the third week in March, if I'm not mistaken, March 21st, 2018. Okay, let's look through the historical shocks and market crashes. In 1973-ish, 1974, you had the stagflationary oil shock, where oil prices spiked. It threw the nation and the world into a turmoil. We first incurred inflation, then deflation, and inflation and deflation, which amounted to stagflation. And you see it had a big jump in unemployment claims, right? Right after that big jump in unemployment claims, you see the you had a big percentage increase in unemployment claims, and then you saw the actual claims themselves spike shortly thereafter. So the increase could be considered a predictive indicator. Okay, here we have 1987, Black Monday. You had a little bit of the same. Okay, here we have 1990. Here we have 2000, the dot-com bubble bursting. Same thing. And here we have the biggest event since the Great Depression. That was the 2008 market crash. Okay, you see again a big spike, bigger than all the spikes except for the stagflationary oil shock event, and then you see employment shooting through the roof. And now you see only 2 weeks of what we're going through now. That is the everything bubble busting and the COVID-19 pandemic lockdown. Take a look at that line and compare it to everything else in recorded history. Just 2 weeks. This is the entire time series. This is just 2 weeks. Move forward 1 month, 2 months, 3 months, 1 quarter, 2 quarter, this chart will be off the screen. Now think about being a credit card lender. Okay, now think about being a credit card lender that serves the subprime market, that private labels, and doesn't serve the cream. Now think about 10 million people per every 2 weeks filing unemployment insurance claims. 10 million people every 2 weeks. That itself is a record. And then think about the economy being shut down in the US for months. Then the economy being shut down in every developed nation for months. Supply side shock, demand side shock, all this. And that's not even an issue that we're encountering. What we're encountering, the real problem, is the everything bubble has burst. We are experiencing totally unprecedented, let's look at the camera. So it says we are experiencing totally unprecedented levels of unemployment, all at a time of record low interest rates, record high risky asset prices, record high Federal Reserve balance sheets, because the Federal Reserve still has all the trash from the last bust in 2008, 2009, 2010 that they were bailing us out of. Treasury bonds, mortgage-backed securities, and who knows what else is on there. And they've resumed the buying now. We have record consumer debt. We'll get to that in a minute. We have record sovereign and municipal debt. And we have the most devastating pandemic this country and the modern world has known, precipitating a global shutdown of nearly all economic activity in every developed nation worldwide. You know, that's something. But you have those who think we're just going to bounce right back in a few weeks or a month or two after the virus is over, despite the fact the virus wasn't the actual problem. It wasn't the impetus, it was the pin that pricked the bubble. So, now this happened before, okay, and it happened in 2008, okay. We predicted it quite accurately. You can always do a search. Is this the breaking of the bear by Reggie Middleton on Bloomberg's blog? Feel free to read through that. Same thing with Layman Brothers, etc. But let's fast forward. Let's take a look at what happened historically and then fast forward to today. So these are a bunch of banks. These are peer group comparables for Synchrony Financial. The blue line, the blue bar, is the 2007 price to book multiple. That's how most analysts value banks, by the price to book value ratio. Banks are valued by book value more so than price to earnings or price to sales or price to cash flow. Okay, the book value, the value of the book in most banks scenarios are the actual loans. Okay, and that in the case of Synchrony or American Express or Capital One, those loans would be consumer credit card and commercial credit card loans. Okay. In 2007, you had an average book value of about 1.5 times, and it varied from bank to bank. So the average is all over the place. In 2008, when the bubble collapsed, right, those book values dropped from 2.2 times book value to 0.75 times to 0.32 times, etc. Why would the book value multiple drop so much? Or a better question to ask is, why in the world would someone sell a bank stock for less than the bank's assets are worth? A book value of 1.0 means that we have a bank with $1 billion worth of assets and we're going to sell it for $1 billion. A book value of 5.0 means we have a bank with $1 billion of assets, but we're going to sell it for $5 billion. Meaning that the bank's operations, right, plus the bank's assets are worth 5 times what those bank's assets are. Okay, the book. A book value of 0.5 means you have a bank with $1 billion worth of assets, but you're selling it for $500 million. Okay, seems like it's counterintuitive because it actually means that you're going to sell the bank for half of what the bank actually has on its books. Okay, but it's not counterintuitive because this is not the result of algorithms. This is the result of real investors that dig down into the balance sheets of banks, do real analysis, and do not take SEC filings or bank management's proclamations as fact. The reason why a bank sells below book values is because the value in book value is not real. Okay? This is an example, the run through of how the value and book value is not real. You saw what the unemployment numbers look like, okay? When you have lost your job and you don't know if you will get a new job, and all jobs and most companies are firing and not hiring and not operating, the last thing that you're going to pay for is your credit card bill. You know, you have other ancillary things to pay for, such as food, shelter, heat, clothing, maybe transportation. So the last thing that you're going to do is pay a credit card bill. You may use that credit card to buy food, shelter, heat, and clothing, running up the bill, increasing the loan amount. But as for paying it, you know, your mortgage comes first. You know, your food comes first, etc. So taking that into consideration, remember, Synchrony is a consumer credit card company. Here are delinquent loans relative to Synchrony Financial's equity stack. This is basically a more colorful version of the chart that I showed you before, that had the amount of delinquent loans as a percentage of their equity. Okay, this area chart is the equity stack, treasury stock, currency translation adjustments, paid in capital, preferred stock, etc. Okay, these bars are delinquent and non-accruing loans from the commercial products, delinquent non-accruing loans from credit cards. Okay, 90 days or more delinquent and accruing loans, and consumer installment loans. Okay, also the consumer installment loans are also part of the non-productive loans. So here we have 2015, 2016, and 2017. You see that their non-performing assets had actually jumped to a significant portion of their actual equity. Somewhere around 1/3 of their actual equity. 2018 has increased, but equity has increased some. In 2019, the non-performing assets are looking better, and there's a significant increase in equity. And then you see Q1, Q2, Q3, Q4, those are our projections. We anticipate these to shoot up significantly. Q1 only has 2 weeks out of the 3 months in that quarter of the economic shutdown, okay, and the job losses. But remember, those job losses started before the economic shutdown, meaning those job losses were basically anticipating the popping or the result of the popping of the everything bubble. Q2 is going to capture everything. These are very conservative because if you take a look at that jump, look at that jump. This line is the biggest line in the history of this country, and that's only capturing 2 weeks. Okay, so we're being very conservative, but even in being very conservative, unemployment is going to shoot up. As unemployment shoots up, the defaults and late payments on credit cards are going to follow, probably exponentially, if not linearly. Okay, and you'll see that by Q4, we anticipate that the losses are going to be greater than the equity of the company. Once you get to that point, the equity value of the company is nil, and the company is worth the exact same amount. So if you're shorting equity, and we're correct in our thesis, and then that company is worth nothing. It's insolvent from a balance sheet perspective. The chances of that happening, you know, very high. Very, very high, considerably over 50%. Or maybe I'm wrong, and like a lot of the pundits on the media says, in a few weeks, a month or two, once the virus is over, we're going to get right back to normal. Of course, normal was the everything bubble that was in the process of popping. So you could be correct in things getting back to normal as long as you consider normal being the popping of the everything bubble, which brings us back to a 2008 plus scenario. Okay, that is best case scenario. This is base case scenario. Pessimistic scenario is considerably worse than the Great Depression. A 17% adverse movement in illiquid lending wipes out the equity in Synchrony Financial as well. We actually have target price, share price calculations on the Synchrony Financial PDF, which is basically this minus which is basically this, but the next page has the target prices. These are just calculations that we've run. From a numerical perspective, it's our illustrative opinion, okay, based upon calculations, observations, and general know-how. We have targeted another consumer lending company as well, whose share price is significantly higher than Synchrony's. Both of these companies have been shooting up in share price, and they've been shooting up at the same time that their prospects has been diving through the floor. Okay, this is either a significant opportunity or we are way off. Almost all the evidence points to support us, and I constantly look for credible counterpoints to our thesis and our argument. Okay, I haven't been this confident about something in quite some time. And there are quite a few other companies, quite a few other sectors that we're looking at, particularly in other geographies. Very bearish on much of Greater Asia, very bearish on much of Europe and the EU. Africa, it's going to get ugly out there. Okay? Put any questions you have for me in the comment section below. If you're interested in purchasing our analysis, it's 3 grams of VE gold, VGLG1, or its equivalent in any of the other VE assets. That's the only thing we will take. If you don't have it, just go up to the beta, dapp.veritasium.com, and purchase it. Okay? I will try my best to be present to answer all the questions, credible questions, in the comment section below. Hit subscribe to subscribe if you haven't. Hit that little notification bell if you haven't. And most importantly, share this video. Okay? For the fact told now.